on the appreciation in the value of that security or stock. Dividends can be reinvested to purchase additional productive assets, especially dividends of a specific company that an investor may have invested in, thereby compounding returns over time. For investors that are focused on building sustainable wealth, dividends are crucial component. They provide a regular income that can be reinvested to further enhance wealth. Now, how does this work? The interplay of capital formation and dividends. 1 second, please. Now, sorry, now the synergy between capital formation and dividends is vital in the pursuit of sustainable wealth. While capital formation may lay the groundwork for providing initial capital or funds to invest, dividends, especially when reinvested, accelerate. I see a hand raised. Oh, sorry, I just ignored that.
Yes, you can go ahead, sir.
Okay, thank you. Especially when the dividends are reinvested, that can, like the example I gave earlier, that can significantly accelerate the growth of the initial capital, creating a very powerful compounding effect that enhances wealth. Now, for investors, it's important how we decide which companies to invest in. So when we invest in focusing on dividend-paying investment that can offer a balance between good dividend and a balance between dividend and capital growth in the value of the stock, when we mix this together, all right, we can have a very, very powerful compounding effect. Now, this approach aligns with the principle of sustainable wealth building, emphasizing long-term growth, risk management, and then financial resilience. Now, you would see I have numbered this slide, one from the bottom and then up. And the reason is that the foundation for capital formation is a generation of savings. Without savings, there can't be capital formation. Now, what are savings? I mean, very simple definition is that a portion of your income that is not consumed but set aside for future use. That future use could be for investment. It could also be for immediate future consumption. Now, without savings, any economy, maybe any household or economy that does not have savings or cannot pull savings together cannot participate in that capital formation process. So savings are a very critical element, in fact, the foundation of capital formation. Now, for individuals, it involves budgeting. Like the example I gave earlier, a meager 100 naira per month over a 5-year period, compounded every month, resulted in a net value of 132,000 at the end of 5 years. So for businesses, on the other hand, how does capital formation happen, or how is it enhanced? Retained earnings, which are profits not distributed as dividends, but kept within the company for future investments. Now, once savings are generated, the next step is how they are mobilized. And there are different ways of mobilizing savings. One way of mobilizing savings is when individuals decide to put money in a savings account or whatever sort of investment in a bank, which then goes to lend out money to entrepreneurs or businesses that require it. One other way of mobilizing savings is when companies come to the market to raise capital All right. So there are different ways of mobilizing savings or accumulating savings and bringing those savings from the excess to areas where they are needed. Now, financial institutions like banks, credit unions, and investment firms play a critical role in the process by facilitating the flow of funds from savers to investors. In the next few slides, we'll be seeing a bit of the structure. I'll be discussing a bit of the structure of the Nigerian capital market. Now, once the savings are then mobilized, they are then invested into various productive assets. And these assets could be physical, they could be human in terms of education, training, healthcare, and all of that. They could also be financial in terms of buying financial instruments like stocks, bonds, mutual funds, and other securities. Now, what are the other elements of capital formation or the things that affect capital formation? Government policies are very critical. Now, they significantly influence the process of capital formation. Policies, for example, that promote savings, policies that, for example, for many of us who have retirement savings account, you'll find that our retirement savings account, the contributions are tax deductible, meaning that we don't pay tax. And the reason is that government is trying to encourage people to save so that capital can be mobilized. So tax incentives, subsidies, for example, and then favorable regulatory environments can encourage both individuals and businesses to save and invest more. Infrastructure development, access to roads, for example, roads that allow farm produce, for example, to be moved, all right, or rail lines that allow farm produce to be moved from areas of production to the areas of consumption can also facilitate capital formation. Education, healthcare, these are some of the areas in which a government could focus on to facilitate the process of capital formation. One of the other elements we discussed earlier is the reinvestment of earnings, which is a very critical part of capital formation. For some of us who may have invested, I know personally, some of my investments for which I receive dividends, there's always this temptation, all right, to consume your dividends. And what I've noticed personally is that those dividends, when I decide not to reinvest them, what then happens is that you typically cannot really place your hands on how you have spent the money. So reinvesting your dividends or your earnings is actually a very, very powerful way of capital formation, of reinforcing the power of capital formation. And that reinvestment cycle helps in the compounding growth and accelerating the process of capital formation over time. Now, capital markets and financial instruments. I mentioned earlier that we'll be seeing slides on the structure of the Nigerian capital market. Capital markets are very critical in the capital formation process because the capital markets bring participants together. On the one hand, the owners of capital, who are the individuals investing, and then the entities that require the capital to put into productive use. So capital markets, including exchanges, these exchanges could be stock exchanges, they could be commodities exchanges, they could be secure derivative exchanges, or a mixture of all of these things. There are some exchanges that have multiple types of securities that are listed on them. The bond markets, and all of these are vital in the capital formation process. They provide the platform for raising long-term capital. Now, one of the elements of capital formation is its patience, in that when you invest, there's a period in which you are patient, you patiently wait for the returns. So the capital markets are significant to raising long-term capital. The developments of sophisticated financial instruments and markets allows for more efficient allocation of resources and risk management. And what does that mean? Capital markets allow for entities that have performed well over time, that have history, all right, to be able to attract additional capital when needed because they build trust. And then because those markets exist, they allow investors to properly and adequately manage their risk, in that there are several elements in terms of regulation, in terms of behavior and all of that, and how people, especially people looking to raise capital, are expected to behave. All of these help in bringing trust and facilitating the process of capital formation. Now, I will try and be very brief here. This is just an overview of the Nigerian capital market. The SEC, the Securities and Exchange Commission, as a apex regulator. And what's the role of the SEC? It maintains primary oversight over the capital market. So all of the players in the market have to submit themselves to the regulation of the SEC. And for investors who wish to invest or who are looking for productive ventures to invest in, it is very important that the first thing you do when you are investing is to ask yourself whether that investment is under the purview of the regulator. Where it is not under the purview of the regulator, then you are going into very, very risky terrain. So to the left, or rather, let me start to the right, you have the exchanges, which are the platforms where that allow capital to be raised. And the major exchanges in Nigeria, the NGX, that's the Nigerian exchange, and the FMDQ exchange, as well as the NASD, which is an OTC exchange. There are several other exchanges, like commodity exchanges, one in Lagos, one in Abuja, that trade commodities. So these operating exchanges basically are platforms for companies to come and list and then be able to attract financing. Further down there, we see the CSCS or the FMDQ depository. And now the depositories, what is the business of a depository? Depositories allow securities to be held in what you call book entry form without the issuance of physical certificates. Now, before depositories, the proof of ownership of any security was a physical certificate. But today, securities can be held in book entry form. And these book entry forms facilitates not just for safekeeping, but it also facilitates trading, because before securities can be traded, they have to first be dematerialized into a depository. Below that is our custodians. And what do? They hold assets on behalf of investors, especially a foreign investor, for example, wishing to participate in the Nigerian capital market would basically typically work through a custodian who will hold those assets on their behalf. Custodians also do a lot more than that, but traditionally, they hold assets on behalf of investors. Now, go to the left. You have the stockbrokers. Basically, stockbrokers are the ones that introduce issuers or the listed companies or the companies seeking to raise capital to the exchanges. And they also conduct KYC for individuals wishing to buy or participate in the capital market. They execute buy and sell orders, amongst many other things that they do. Below that are registrars. What do? Registrars maintain membership registers of companies or collective investment schemes. They do a lot more than that. For example, registrars administer the annual general meetings of companies, where they ensure that only bona fide investors access those meetings and are able to vote to make decisions. Now, below that are trustees. What do trustees do? They provide trust services for both CIS and bonds, and they maintain assets. Now, one critical thing also that trustees do is that they help in estate planning. One element of sustainable wealth is actually estate planning, which allows you to properly structure your wealth in such a way that it is not only tax efficient, but also allows for transfer upon your eventual departure from this world, if I may use that language. Now, next to that are the investors who originate others. And the investors are the owners of capital, those that bring their monies to these platforms for companies to access for the purpose of investing. Beside that are issuing houses. Now, issuing houses working together with stockbrokers, registrars, and other capital market operators are the ones that actually handhold issuing companies and bring them forward to the market to offer their shares to the public for purchase or for investment. There are also fund managers, rating agencies, auditors, and several other players that are regulated by the SEC before they can participate in the market. Now, we'll look at the impact of capital formation. Like I said earlier, any economy that is unable to aggregate savings in an efficient way and deploy those savings to productive ventures, we have significant challenges in growing. An economy that is able to do that can significantly increase the stock of capital and enhance productive capacity, which can lead to higher economic output and, of course, growth. One other impact of capital formation is job creation. The fact that people, businesses can look to the market or the capital market or to savings or to banks, wherever they are sourcing capital from, and be able to source money, all right, to create new businesses. Therefore, we're able to create jobs. This is very critical. Tied to that, of course, is technological advancement. And this is almost like a chicken or an egg situation. Now, on the one hand, capital formation supports technological innovation, all right? And on the other hand, technological innovation enhances the capital markets, all right? Which then enhances or sort of democratizes access to the capital markets, which then further supports development. So it's like a cycle where one helps the other and then the other grows in return. Now, one impact of capital formation is that it helps in income distribution, which is why governments have to be deliberate in putting in policies that help or drive capital formation, especially around incentives around taxation and all. Now, what are the sources of capital formation? We've gone over this in some of the previous slides. Personal savings like household savings and retirement accounts, like we mentioned earlier. Of course, corporate savings from retained earnings, government savings, especially for governments that wish to have monies to invest in critical areas of the economy. And then there's external borrowing, the capital markets, like we said earlier, and then, of course, the banking system, and then all other non-banking financial institutions that provide access to capital or funding, like the venture capital firms. Now, what are the challenges to capital formation? One very critical challenge is low saving rates. Now, the idea is that the more people can save, the more capital can be mobilized to enhance economic activities or development. Where savings are inadequate, it limits the ability for capital formation. Now, inefficient financial systems could also be a challenge to capital formation. Weak financial institutions and underdeveloped capital markets can hinder this. One of the reasons for the recent banking recapitalization in Nigeria is to strengthen the banks so that they can be catalysts for economic development and growth. Political and economic instability could also hinder the process of capital formation. Fiscal policies, monetary policies, inflation, which drive interest rates and exchange rates and all of that, can deter investments and disrupt the capital formation process. Uncertainty is a very, very, very big challenge to capital formation, where people are uncertain about the future. They sometimes hold back in determining how they invest. Inequality, high levels of inequality can also hinder the capital formation process. Investor preferences could also hinder. We'll find some of our younger people, for example, who prefer to invest in cryptocurrencies or unregulated investments that oftentimes end up going bad. All right, so we have innovation could also, or the lack of it rather, could also hinder capital formation. Now, how do we define sustainable wealth? In an article published in Global Banking and Finance, written by Maja Bovnoska, in that article, the lady describes sustainable wealth as the future benefit that sustains future life. Sustainable wealth means consumption or using up of benefits must equal additional investments that increase wealth, so wealth is maintained and sustained. Now, sustainable wealth is not just about numbers, neither is it about accumulation. It is about the strategic orchestration of those numbers over time. It involves growth, management, preservation, and the often overlooked element of transfer. Wealth built over time has to be managed, has to be grown, has to be preserved, and then there has to be a process of transfer, like I mentioned earlier, which is where trustees come in to help to structure your estate in such a manner that it is not only just tax efficient, but can easily be transferred. Now, we need to link the two, sustainable wealth creation and capital formation and dividends. Now, capital formation and dividends are intrinsically linked in the process of sustainable wealth creation. And it involves accumulating, we've defined that earlier, financial resources through savings and investments or retained earnings for companies. And these resources are then invested in productive assets, fueling economic growth and generating profits. Dividends, on the other hand, represent distribution of a portion of these profits back to shareholders or investors, as the case may be, depending on the kind of assets. Now, reinvesting earnings for companies by retaining and reinvesting earnings in growth opportunities, such as expanding their operations, developing new products, or acquiring new assets, or mergers and acquisition. Now, in investment banking, there's a saying that cash is king, which is why we will find companies that are cash rich able to take over companies that are struggling for cash. In fact, in investment banking, it is said that a company would die faster from not having cash than from not having profit. So accumulating financial assets is a very critical element in the process of sustainable wealth creation. Now, dividends, especially regular dividends, provide immediate returns to investors, which can be reinvested in the same company or some other investments. This investment by shareholders then creates a cycle of capital formation and then growth. And then it's a vicious cycle that goes on and on. Now, achieving sustainable wealth creation requires a delicate balance between reinvestment and shareholder returns. And this balanced approach means setting a sustainable dividend policy for companies for them to be able to establish a pattern that would then interest the investing public in their security. And then this is a long-term growth strategy for any company that wishes to attract investors. Communication with investors is also very critical, not just about earnings, not just about earnings, but about their plans, their growth prospects, and all of that. And one very critical responsibility of a registrar, like Coronation registrars that have facilitated this webinar, is shareholder communication. So companies need to communicate their goals, their vision to the investing public to help the public understand what they are doing, and then for them to be able to mobilize investment from these investors. Now, what are the strategies for sustainable growth? Like we said earlier, sustainable growth is about adopting a long-term approach rather than seeking such short-term gains. Now, the capital market, like I personally would always like to say, is not gambling. It is actually looking at the opportunities that are there and having a long-term view of where those opportunities will end. It's interesting to note that it is only the capital market that has been known to be able to beat inflation over time. Today, for example, the Nigerian exchange has performed at about 33% year to date, while inflation is about 36%. I doubt that there is any investment that will deliver, that is safe, regulated, and that would deliver those kind of returns. So a long-term approach is critical in sustainable wealth creation. Now, focusing on quality investments is also critical. We need to prioritize investments in high-quality companies with very strong fundamentals. And how do we know which companies have these strong fundamentals? By talking to the people that know the business, the stockbrokers. Like we said earlier, the stockbrokers are the ones, they are the bridge between the companies that need capital and the investing public that need to deploy those capital. So you need to look at quality investments, companies that have strong fundamentals, reliable earnings, and a history of dividend payments, which ensures steady income stream and growth potential. The other element or strategy, rather, for sustainable growth, wealth is diversification. You have to have a well-diversified portfolio across different asset classes. Asset classes like stocks, which provide the upside of when companies are, over time, you can build, it could be accretive in terms of the value of the security, as well as dividend payments, and then bonds, other securities, well diversified, such that your risk is spread, so to say, and where one sector may not be doing well, it's unlikely that every other sector won't be doing well. So take, for example, during COVID, while certain sectors were having significant difficulties, the food vendors were making a kill. All right. So companies that are involved in food production, because people had to eat, notwithstanding the fact that there was a lockdown. So having a well-diversified portfolio ensures that you're able to spread your risk and your portfolio doesn't suffer shocks when one particular segment of the economy is not doing well. Now, one other strategy is a regular review and adjustment. Working with your investment advisors. For many of us, we are not able to do this alone. For some of us, we can do this. It's important that on a regular basis, we review our strategy based on market conditions and economic trends and personal financial goals. And then by doing this, we ensure that we are constantly ahead, at least, or abreast of the market and taking decisions that can enhance the value of our investment significantly over time. The other strategy is staying informed about capital markets and investment opportunities, talking to your advisors on a regular basis, and listening to, of course, webinars like this. Now, we'll look at two case studies. One is a personal case study, the other is a corporate case study. I'm sure there are a couple of us on this call that know Warren Buffett. According to Forbes, I think Warren Buffett is probably like the fourth or the third richest person in the world today. And how did Warren Buffett, many of us may not end up as Warren Buffett, unlikely, but at least we can build sustainable wealth. And the question, how did Warren Buffett build his wealth? Today, his worth, as of, I think, June or July, according to Forbes, Warren Buffett is worth $134 billion. He's the chairman and CEO of Berkshire Hathaway. How did he build his wealth? It was accumulated over time, over a long period, through investing, starting at the age of 11. That's how far back he started. Now, at 14, he had saved up about $1,200. By the time he left college, he had grown it to almost $10,000. Now, what is Warren Buffett's investing philosophy? In his autobiography, Buffett describes compounding. We talked about compounding earlier as a snowball rolling down a long hill, picking up more snow as it gains momentum until it becomes a massive snowball. Buffett is known to love compounding interest because it works alongside his investing philosophy. And one of the wealthiest people in the world, the 93-year-old, is an example of compound interest as the 8th wonder of the world. Interestingly, Albert Einstein described compound interest as the 8th wonder of the world. What other key elements to Buffett's success is long-term thinking, exemplified in one of Buffett's most famous quotes about knowing he would be rich, yet not being in a hurry to get there. Notoriously patient, the wealth of Berkshire and Buffett is associated with the importance of value growth over time. Berkshire's portfolio has held on to some stocks for close to 30 years. That's our first case story. Like I said earlier, unlikely that many of us will be the third or the fourth richest persons on planet Earth. But there are various examples of very rich people across the world who have become rich by being disciplined and looking long-term. And of course, relying on the power of compounding, reinvesting their returns and allowing the investments to grow at a much faster rate than it would have ordinarily. Our second case study, we are bringing it home, is a company. Many of us, of course, virtually all of us on this call know Alhaji Aliko Dangote. And how did he start? He started as a trader. Many people, I think we should all go and read the story of Alhaji Aliko Dangote. His initial trading business was facilitated by his uncle. Now, one area I didn't point out at the beginning was that capital formation can also come through borrowing from family, not just the banks. In the case of Alhaji Aliko Dangote, his initial capital came from his maternal uncle. And then he started a trading business, and over time built up capital to then invest in productive venture. And over time, his businesses have developed into conglomerates. Cement, I think he's exited the flour business, but he's in cement, he's in oil and gas, the Dangote refinery, is in foods, sugar, and all of that, all coming from capital built over time and then reinvesting that capital. Now, Dangote Cement is the largest cement producer in Nigeria and has significant presence across Africa. It generates substantial cash flow. We talked about that earlier, from its cement production and sales, reinvesting and expanding its production capacity and exploring new markets. Dangote Cement has a very strong track record of paying dividends consistently to its shareholders. I can tell you authoritatively that Dangote Cement has a very robust shareholder base cutting across local, foreign investors, all sorts of very prominent. It has a very robust investor base due to its track record. Now, sustainability. Continuous investment in expanding production capacity and improving efficiency supports long-term growth. Diversification into other African markets has helped it to reduce reliance on the Nigerian market and hedge against currency risk. Dangote Cement generates its own electricity, has made significant investment in ensuring that it enhances its productive base. So these are two examples, one a private individual and the other a listed entity. So in conclusion, understanding and leveraging the power of compounding and the role of savings and dividends in the capital formation process are essential for anyone seeking to build and maintain sustainable wealth. And by combining disciplined savings and investing with strategic focus on dividend-paying assets, individuals can create a robust and resilient financial foundation. And this approach not only supports personal financial goals, but also contributes to the broader economic stability and growth. And what I would like to advise today is to talk to your investment professional, whether a stockbroker, whether it's a trustee, whether it's a fund manager, to start this journey of building sustainable wealth. Thank you.
Thank you very much, Mr. Oturu, for that very comprehensive presentation. So much to unpack there, and I believe that it's been very valuable to our audience. I see that we did have someone raise a hand earlier, and I just wanted to just reiterate that we'll only be taking questions that are typed into the Q&A field. So if you have questions or contributions that you want to make, please, again, I want to encourage you to type them into the Q&A field, and we'll get to them as we proceed even now into the panel conversation. So thank you again, Mr. Oturu, for that. Now, Mr. Oturu will also be participating in the panel, but in addition, I would like to introduce two other panelists that will be joining him as we continue to look into this theme of capital formation, dividends, and shareholder wealth. The first is Mr. John Briggs. He is a Deputy Director and seasoned regulatory compliance specialist at the Securities and Exchange Commission, Nigeria. He has over 23 years of experience in the financial service industry and has been instrumental in promoting investor protection, market integrity, and transparency. His deep understanding of financial regulations and commitment to market fairness makes him an invaluable contributor to today's session. So we do welcome Mr. John Briggs. A pleasure to have you, sir.
Thank you very much.
We also have joining us Mrs. Chiamaka Ogo Obidike. She is the Chief Client Officer at Coronation Registrars, and with nearly 2 decades of experience in the financial services sector, she has led efforts in customer service, operations, and digital transformation. Her expertise in driving growth through excellent customer service, especially in the capital markets, positions her as a key voice in today's conversation. So we look forward to hearing from her. It's a pleasure to have you join us, Chiamaka.
Thank you, Mr. Wale. Thank you for having me.
Let's get right to it. So as I did mention, we'll be taking your questions if you do have them. So please continue to type them in. We'll get to them shortly. But if I can maybe start with Mr. Briggs, because the regulator at the end of the day enables so much in the financial services space. So from a regulatory perspective, how does the SEC ensure that capital formation processes are fair and transparent for all investors? Mr. Woturo has said quite a lot about it, but at the end of the day, we know how markets can be very dynamic and some people may have advantages over others. So wanted to hear your perspective on how the SEC ensures fairness.
Okay, thank you. Just to reiterate a bit, capital formation, like we know, goes beyond just cash. Yes, cash is king. There are other aspects of capital that one will also look at in terms of expertise and all that. Which, of course, if you look at the venture capital process, you see that people bring their expertise. Then, of course, cash comes in to be able to help in that. Now, for sustainability wealth, the capital market is just the best place if you talk about sustainability in terms of the fact that it's a market where you do medium to long term. So what is the regulator doing? The regulator is always poised to make sure that we have a fair, transparent, and efficient market. And how do we do that? All securities that are traded publicly are expected to be registered by the Securities and Exchange Commission. Now, I heard Sheyi saying that, of course, when you're investing, you have to make sure you do your investment with securities that are registered and are listed in the exchanges. This is key because those companies, when they get registered and regulated by the commission, there is a requirement for transparency in terms of reporting, regular reporting. The companies, as we know, will ensure that they make their monthly, quarterly, half-yearly, and annual reporting, which is reviewed. And of course, there's also issue of corporate governance, which is key. And of course, talking about sustainability, in an organization that does not have good corporate governance, you find out that issues of sustainability, ability to pay dividend as it should be, or even talk about dividend reinvestment, is not so possible. So the commission ensures that corporate governance issues are taken seriously, monitor it carefully, and of course, we have a robust rule-making process because the market is so dynamic that there are a lot of changes every day. So we continue to ensure that we come up with rules that guides the market. And of course, compliance is key. In a market like this, the regulator is poised to make sure that everybody who plays in this market must comply. And we ensure full enforcement of those who fail to comply with this market. So as a regulator, we also monitor trading on exchanges. We do an oversight to make sure that these exchanges are operating in line with their rules. And of course, just to mention investor education, which is what we are doing here today, because if investors are quite educated, definitely they will understand what to invest in and how to invest. And it's important to mention that in investment, you ensure that the issue of your objective, yes, you have mobilized capital, there must be an objective. And in investing, you must decide what are the risks you can bear before you decide to say, okay, I'm doing some long kind of investment, which is, of course, sustainable. And your taste for environmental issues, ESG issues, can also guide you into a whole lot of sustainable work. So these are some of the things that the regulator in Nigeria today as SEC is doing, and a lot more. Thank you.
Thank you very much for sharing that. And we appreciate the efforts of the SEC. We have quite a number of questions, and I'm actually going to try and go to them very early. But before that, just a few more points to touch with our other panelists. And the first one will be on Mrs. Chiamaka Ugobidige. Now, a lot has been said about technology, so I want to hear your thoughts about how Coronation specifically leveraging digital transformation to enhance customer experience in the capital formation process. What can you tell us about that?
Thank you very much, Mr. Wuli. Technology is very key to driving capital formation and in the capital market amongst investors. And at Coronation, we are very big on technology because that's what makes for a seamless customer experience. So we have technology address different areas of the investor's journey, from the way we communicate with them. It's no longer manual. They don't need to come all the way to our office to get answers to their questions. We have a 24/7 contact center that is always available to, manage inquiries, requests, as the case may be. We also have a portal where they can have access to their investment portfolio. You can see latest information, updates, their dividend histories, and everything. That's Shareholder Life by Coronation. Then for our clients, we also have a platform, Issuer Life by Coronation, where they can, have analytics of their investors and everything. And we have e-meetings management that, helps to promote trust between the shareholders and the companies that they invest with, to hold meetings and pass across information. And the interesting thing about our meetings management solution that it's hybrid. They can it supports online meetings, meaning that shareholders can join their meetings, their companies' meetings from anywhere in the world. So we're really leveraging technology to build trust in the capital market. And one of the other interesting innovation we have in Coronation is the Coronation Wealth. And what that has done is to democratize capital formation by enabling people to invest seamlessly from everywhere, from the comfort of their home. So at Coronation, it's not a journey that is ending today, because there's still more in the pipeline that we are coming up with to make investing easy for the populace. Thank you.
Please, thank you for that. But on that, can you just clarify that last point about being able to invest? Because typically, many people, when they think of registrars, they're thinking of their dividends, their
yes,
bonus shares.
thank you very much.
But now you are saying they can.
Yeah, thank you, Wale. Yes, so when people think about registrars, what comes to their mind is dividend payments, but it's beyond that. And the capital market is an ecosystem, and Coronation is, as a group, is a bigger ecosystem where we have other entities. So we, as registrars, we achieve democratizing wealth through orchestration, through partnership with other entity players. So we have a registrar to broker platform through which people can invest, can trade in their shares, buy shares, and we buy mutual funds and the rest. And we also have registrar to bank, bank to broker that also partner with banks to allow account holders to open brokerage accounts, and everything is very, very seamless. So partnership and orchestration is one of the way we as registrars are driving this in the capital market.
Thank you very much for clarifying that. Appreciate it. Okay, like I said, we want to go to some questions very quickly because we have quite a number of them. So the first one says, how can dividends be reinvested? Are they made at the initial point of a public offer request, or at the point when it is earned? So I guess the question here is it possible to automate that process even from the point of the public offering? I was wondering if Mr. Owoturo can also speak to this.
Thank you, Wale. It's an interesting question. So today, for mutual funds are structured, that's a collective investment schemes that pool funds together to buy securities. They have been able to establish that protocol where investors can, at the point of entry, indicate whether they want to reinvest their dividend. Unlike stocks or shares where that protocol has not been established yet. It's not an established protocol. So an investor in stocks that are listed would have to, for example, give an instruction to their broker as well as the registrar to that security that they wish to reinvest their dividend, and that protocol set up.
But I guess the question is, why can't that be done at the point of even buying?
It's an important, that's why I said it's an interesting question. So it's something we as registrars have to look at together with the other participants, the issuing houses, the stockbrokers, and of course, that kind of process would have to be approved by the SEC. So, but it's something we would have to take up from this. And this is why some of these engagements are important. So we see what the market needs and be able to provide.
We have Mr. Briggs here from the SEC. So perhaps it's a very interesting conversation to have. I imagine that the technology and competence is available at places like Coronation registrars, where you can actually give the instructions and let them know how you would like your dividends to be appropriated, even at the time that you're investing. So what are your thoughts on this, Mr. Briggs?
Yeah, my thoughts are clear. It's a good thing today we are talking about digitalization of the capital market. So technology would actually make this work. And, you know, for the SEC, we work with the rules. So some of these things the rules will have to be amended. But though I think somewhere I saw Chevron had some kind of dividend investment plan, which I saw, and I think Coca-Cola also, although not in Nigeria, have some dividend investment plan. So it's something that the market needs, and the commission is poised to, at every point in time, based on its rule-making process, is willing to amend the rules, and technology will make it very easy to be implemented. Yeah, so that's what I would say.
I do think it's something to look at, more so when you consider that these days investors are not just local, but they're international. And so if you give them the opportunity when they are making that investment to also guide how they would like any dividends that come out of those investments to be appropriated, I think it just makes the process seamless. We have less issues around unclaimed dividends for many years. But I just thought that was a very important.
So if I may, Wale,
point to touch.
if I may, Wale,
Yes, please go ahead.
dividend reinvestment today happens, all right, and it can happen, but it's happening a one-on-one or one-to-one. So an investor who wishes to reinvest their dividend can approach their stockbroker or the registrar to that security, and the registrar can set it up, but in terms of on a larger scale and making it a protocol, then we have to work alongside the regulator to make that happen. Thank you.
Mr. Briggs, you raised your hand. I thought you wanted to add something.
Yeah, so I just wanted to say to my brother Sheyi here, I think as the president of his association, these things can be actually done clearly through some submission from his association to the commission, so that it can be by way of a rule that the options are available for you at the point of a public offer. So that makes it a bit more better. Thank you. But is it applicable? Yes, there are people who do that. Like he has said, the mutual funds, there is provision for reinvestment of your distribution at inception. And at any point in time when you want to change, you can also say, okay, look, roll over my distribution. But we don't have that in the equity market in Nigeria today. So I think technology, like I said, will make it a bit more seamless and more better for us. Thank you.
Chairman, do you want to talk about this before I move on?
Yes, very well. Just to add that at Coronation, we have already seen that need because we've been speaking with shareholders and they've expressed the need to have that. And we're already working on that already. Maybe not at the point of entry as we're discussing right now. That would be, the approval for that will be received holistically. But today, if you want to reinvest your dividend, we have a procedure for that. And the next step is to digitize that process. And that's what we call a registrar to broker platform. That will go live soon. But currently, for any shareholder that wants to reinvest their dividend, there's a procedure for that. They can reach out to our contact center, customer care at coronationregistrars.com. For all the registers that we manage, we can facilitate the process for them. Thank you.
Thank you for that. I appreciate it. Let's move on to other questions because we have quite a few. There's one here. Is there an automated way to reinvest dividends without having to be paid first by the company? I think we've spoken to this to some extent, but maybe Chiamaka can speak more. I asked my stockbroker this question last year, and I was told that this feature is currently not available. So Chiamaka, you want to speak to that, please?
Thank you, Ale. Yes, thank you. So like I said, while we are working on the digital platform that will facilitate that dividend reinvestment, we currently have a process for it. So if you want to reinvest your dividend, just send us an email at customercare@coronationregistrars.com and we'll guide you. It's a very seamless process. We'll guide you through that. And we already have shareholders who are already taking advantage of this opportunity. Thank you.
Okay. Thank you for that. Okay, there's another question here, and it's a bit of a long one, but something to reflect on. Why is it that when an investor relies on investing in a dividend-paying stock, such as MTN Nigeria, as he has listed here, for receiving regular cash dividends, and the dividend-paying stock have been paying the shareholders regular cash dividends, the dividend company suddenly stops being a dividend stock, and then what can the investor do to their shares in this company when the company has stopped its cash dividend payments to the investor as returns on their investment in it? Maybe we can get Mr. Wuturu to speak to this. So companies don't have any obligation to pay dividends. Maybe some people have come to get used to getting paid by one, and then they're disappointed when they do not pay. So how do we navigate that in the whole context of this conversation?
So another interesting question. So specifically to the case of MTN, you know, when the Naira was devalued, MTN had a lot of foreign currency obligations. Many of their equipment are imported. They had letters of credit that were issued in foreign currency. So it sort of caught them suddenly. And then by the time they revalued those commitments, it practically wiped off their profits or even their shareholders' funds. So MTN, for the first time in its existence, didn't pay dividend this year. So it's a temporary thing, really. And which was why we said that your portfolio should be diversified such that when one sector suffers a setback, it doesn't affect your entire portfolio. But for me, I'm an investor in MTN personally. I'm not selling my shares because this is just a temporary setback. MTN is a hugely profitable entity. I mean, we can see it from their revenues from their last published account. So it's a temporary setback in my view. But what you can do as an investor, you have the option of selling your security, which is the beauty of investing in an organized platform like the NGX that is regulated. You have the option of instructing your broker to sell that security. But of course, taking advice first before going ahead with that decision. Thank you.
Thank you very much for that. We also want to acknowledge audience joining us on YouTube. We do see some of your questions as well, so we'd like to take some as well. Someone is asking, do you think the sanctions for corporate governance breaches are really enough to deter operators? And I'm thinking in the context of the conversation we're having here, perhaps one could be perhaps not funding dividend payments as required. I just wanted to hear maybe from the representative of the SEC, Mr. Briggs, do we have enough deterrence for corporate governance breaches in Nigeria's market?
You see, issues of corporate governance, they speak for themselves. Today, companies are allowed to report themselves in terms of corporate governance. And by the way you report, the first deterrent will be that a company that is known for non-compliance with corporate governance will suffer the first hit of ethical investors who will not want to invest in that company. And if that happens, of course, the company will lose capital. That is one. Then, of course, there are breaches. There are requirements on the code of the corporate governance, which requires that if you violate, there are a whole lot of punishments that you can be meted with. Penalties are there for corporate governance issues. Of course, we investigate a whole lot of issues through whistleblowing, and we'll find those culpable in terms of related party transaction, conflict of interest, and all that. Penalties are there to be meted. But companies who violate corporate governance, the first hit is that you lose ethical investors, and our market today is people are becoming more aware. People now know their rights. Shareholders associations know their rights. They know what corporate governance is all about. And we have encouraged that companies are there to corporate governance. For instance, the national code covers, and the capital market have its own guideline, which will expect companies that are listed in the market to adhere to. And from time to time, I don't want to be specific on companies that the commission has investigated on corporate governance issues and actions that are taken, because we are speaking in a forum like this. So,
but perhaps one thing that may be relevant to point out is there some kind of structure or platform, maybe whistleblowing contacts?
Yeah, sure. There is whistleblowing.
That and how maybe you can guide audience on how they can access that if they see breaches themselves.
Okay, so for instance, there is a complaint management framework that we have in the capital market that requires you to complain what you see. And I know that the commission also have a whistleblowing index because recently we have received a few whistleblowing. It comes in the form of complaint, right? Somebody just comes to complain that these things are happening. And, we have to go in and investigate, do our investigation. And if the companies are culpable, the directors that are involved are punished, then the company itself is also punished. There have been instances where people have been banned from holding directorship in the market for life. We have a few of them on the basis of violating corporate governance code. Corporate governance is so entangled that by the time it comes up with the issue of even corruption in terms of malpractices that you might see can be entangled into corporate governance and move towards violation of most of the rules and regulations. So it's not just about non-payment of dividend, which we are talking about. And of course, there is something that is important, as you say, in terms of payment of dividend. Dividend is paid out of profit. So for an investor who is investing in a company, and if you look at the economic instability and you realize that your company is no more paying dividend, then you might just have to look at the books. You will see along the line that the company is not making profit. And if a company is not making profit, you don't need to go and borrow to pay dividend, because that again will be against the corporate governance that we are crying about, right? So you now also want to look at it that, okay, is the company not making profit? Does it mean that the directors are trying to overpay themselves, which is also against the corporate governance, right? So there are a whole lot of dynamics that we need to be clear with before we emphasize the issue of non-payment. Yeah, thanks.
I appreciate, and we do have so many questions, and I want to get to as many of them as possible. Well, Mr. Oturo, if you can briefly comment, I see your hand up. Very briefly, if you can.
Thank you. So ultimately, Mr. Briggs has provided the foundation, but ultimately, investment in any market, regulated or not, involves risk. And I'll take our minds back to the years of military rule, where the punishment for armed robbery was firing squad. And it's been known that at Bar Beach, when armed robbers were being executed, you find people trying to steal. So ultimately, the laws are meant for those who ordinarily would not want to do something because they will get punished. So the regulator is there as a supervisor of that process. And you find companies that have been listed on the exchange for, almost as long as Nigeria has existed. So, and they are still there today. So basically, and you find many who are not regulated have gone down because the regulation is not there. So that protection is there, but investors too have to ensure that they are knowledgeable and they keep abreast of the market. Thank you.
Thank you, sir. Okay, quick question, and if we can, a bit of like a rapid fire style, because we have so many of them. Okay, but I think some of them are very good. Kunle is asking, putting my money into a savings account, which paid interest monthly and adding up to with deposit monthly as well, can this be termed as compounding? So basically keeping your money in a savings account and the conversation about compounding. Mr. Wotoro, can you just comment briefly on that?
Yes, it does compound. But the question is, how aggressive is that compounding? During the presentation, I mentioned that it's been known, it's a known fact that the only investment that has almost consistently beaten inflation is an investment in equity, because you participate fully in the upside. If you invest in a savings account, the risk is minimized, your returns are guaranteed, but the rate of compounding can never equal if you took some. So we said a balanced portfolio where you spread your investment between different asset classes, some in cash in a savings account, some in bonds, some in shares. That is what builds a healthy portfolio that can then be sustainable. Putting all your money in a savings account, trust me, is not a sustainable way to build wealth. Thank you.
All right, thank you, sir. We have another question from Banjo, who is joining us on YouTube, and he's asking, on what basis will the regulator allow the prices of bank IPOs to be higher than the prevailing market price of their shares? Now, I think this has come up in recent engagements. So perhaps, Mr. Briggs, you want to comment, is that really what is happening? Is that what the regulator does, or is this more a case of prevailing market forces at play?
Okay, so, valuation is very important in securities offering. So I guess what is at play will be issues of valuation. And although it might look, anyway, let me just leave it at that valuation is clear. And we at the SEC, we always look at valuation and the basis of valuation before we approve any form of public offering. So I think I'll leave it at that.
Okay, so essentially the SEC looks at what is presented by the issuer and assesses the price at which they would like to go to the market, and on that basis, after that review, approves it. Now, the market trends obviously are more dynamic, and so at some point we could see the share price fall below the offer price. So it's not. Anyway, Mr. Wotoro, I see your hand up. You can speak very briefly to this, sir.
You've actually almost, you both answered it basically. At the point where the SEC approves an offer, it's typical for a public offer to have some element of a discount to the market price. But markets are not stable. Market sentiments change. So between when the offer comes to the public, market sentiments can change. Availability of that security on the floor may increase. And where availability increases, what then happens is that prices may fall. But ultimately, investors need to decide how they wish to participate. Thank you.
Thank you very much. And someone's asking if the Zoom recording will be available to rewatch. It's actually available on YouTube, so you can certainly play it back later if you want. Now, there's a question here. Can the registrar select a single central repository? I'm not too clear what is being asked here, but Chiamaka, do you want to speak to that?
Okay, so for depository, I'm not very sure what the question is, but I'll just speak about the depository that we have in the country. So that's the CSCS and the FMDQ for bonds. CSCS is for other type of stocks. So those are the two that we have. It's not something that a single investor can choose. It depends on the stock that you buy that determines the depository that houses that. So essentially we have two, the CSCS and FMDQ. Thank you.
Understood. Okay, thank you for that. And there's another question about how I reinvest my dividends, what platforms are available. I think we've spoken quite a bit on that already, so maybe we can move on. There's another question here. Can a broker select a single central repository or records are automatically available on both? Not sure if this, I think you've mentioned the issue about the depositories that we have, so I'll move on from that as well. There's another question here that says, I have shares of a company's registered with a particular stockbroker in Lagos. Their emails and websites are dormant. I am not able to reach out to sell or even upgrade the stock. I bought the stock of the company and registered with another stockbroking company, thinking they could help me reach out to the fellow stockbroker, but it proved abortive. What can I do to have control of these stocks? So it sounds like this is a case of a person investing through a stockbroker, and that stockbroker is incommunicado and is unable to trade on that. And he wants to know what recourse he has. Anyone want to take a stab at this?
So for me, I would say his best option is if he has to write to the commission and lay a complaint. Since he can't meet the stockbroker, it's expected that the stockbroker should be a registered stockbroker and would have changed his address. And if he does that, then he ought to have notified the commission. So he should communicate to the commission in any of our zonal offices or the head office. If it's in Lagos, our office is at number 3, Dejo Street. He can bring a complaint, then we'll investigate to find out why he's not getting in touch with his stockbroker.
Thank you for that.
Yeah.
All right. Okay, there's another question here about inflation, and that is a real thing these days. How do we invest in the face of inflation and high interest rates? Oftentimes, investment yields are poor and the capital invested depreciates as a result, making the investment a huge loss. I have never recovered from the Union Bank shares I bought in 2012 that was lost and never appreciated till date, and the company was acquired. So the issue about investment and inflation, I wonder if Mr. Waturu wants to speak to that.
If I don't know at what point, this is a very engaged audience if I may say. I mean, interesting questions. During the presentation, I said that the only investment that has been known to beat inflation is actually the equities market. Sometimes it's good for some sectors. Sometimes it's not so good. I will reiterate again, it's important to spread your risk. The banking stocks took a hit a few years ago, and many investors that participated are yet to recover. I can tell you that a number of my personal investments have beat inflation significantly. And that is because I was deliberate about how I made my investment. So for example, investing in a company that has some element of its income in foreign currency, for example, helps you to hedge against Naira devaluation because they are earning dollar. So if you invested in an oil and gas company that exports crude or gas, for example, when Naira is devalued, because some element of their income is in foreign currency, you continue to earn. So there are all sorts of arrangements where you can balance returns, risk, and the effect or impact of inflation, which is why it's important for you to talk to the professionals before you invest. A lot of people invested because somebody told them to a friend, so I bought these shares, or, without going to those that have the knowledge. Investing can be very profitable. It can also be very unprofitable if you do it wrongly, which is why we always say, talk to the professionals to guide you. Thank you.
Thank you for that, sir. Okay, there's a question here about how can one sell shares if they wish. Now, imagine this speaks to a person who has invested in a public offer. Now, we know in the past, public offerings, you could get you should get a share certificate, but now I know many things have gone electronic. So perhaps, Chiamaka, you can speak to this, the experience of investors in public offerings now.
Thank you, Mr. Wode. So if you want to sell your shares, your stockbroker is the go-to person. Speak with your stockbroker. They'll guide you on how to make that sale. Many stockbroking firms have also digitized that process such that you can do it by yourself. Like with Coronation Securities, we have the Coronation Wealth. You can download the platform, you can download the app on your phone, and with that you can trade and buy your shares. Also, you can also, for people that have accounts with Access Bank, you can also make that trade using the Access. So talking about orchestration and partnership, some stockbroking firm has also partnered with banks. So if you have your bank apps, you can also be able to trade on your shares. But primarily, if you want to sell, you can reach out to your stockbroker. And if you don't have a stockbroker, you can go online on the SEC website to see list of approved licensed stockbrokers. You can choose any of them. And if you are still in doubt as to who to work with, Coronation Securities is there. You can reach out to us and customer care at coronationregistrars.com, and we'll refer you appropriately. Thank you.
Thank you for that. There's a question here. What can I do to reclaim my investments in companies that have closed shop? I guess the short answer to that is that, unfortunately, you have lost your investments if they have closed shop. So I wonder if any of our speakers want to add to that.
I can add to that. If it's a listed company and it has delisted, the monies are somewhere. So you can approach either the previous registrar to that company before they delisted, or your stockbroker. They know what to do. So if it's it was a regulated entity, your money is probably sitting somewhere. Thank you.
Well, of course, that assumes that the company is still in existence. But yes, absolutely. Thank you for that. Now, there's a question here: how does compounding effects play in terms of non-dividend paying stocks? Well, I wonder if Mr. Wotoro wants to speak to that as well.
Well, so compounding can also work for non-dividend paying stocks. But the question is, why would you want to invest in a non-dividend paying stock? I know, for example, Apple for several years did not pay a dividend, but investors had significant capital appreciation. So that was Apple's policy. So in that regard, what you then want to do is to continue to add to your investment. It means that you have to look for alternative sources of cash to then enjoy the benefit of compounding. So like we said earlier, every individual has an investment goal, and it's important you talk to your investment professional that can help you to and guide you through that process. But typically, if a company is not part of its policy not to pay dividend, all right, the only other reason why that company may not be paying dividend is because it is not making profit. And you need to then review your investment in that entity, because after a while, it then means that if they continue not making profit, then your investment may be at risk. So that could be early signs of a problem. Thank you.
Thank you very much for that. And I guess to some extent, we could even consider script or bonus shares as some form of compounding, especially when the share price begins to appreciate.
You are very correct. In fact, Wale, maybe you should have been the one. You are very correct. Thank you.
I'm just thinking out loud. Okay. All right. Okay, more questions. Okay, now this is a more general point. I want to ask that with the ongoing geopolitical tensions and economic uncertainties, not just in Nigeria, but all over the world, what are the best practices for preserving capital and ensuring sustainable growth? So this is a bit more of financial and wealth advisory here. I wonder if anyone would like to take a stab at that. Yeah, you said, sir.
Okay, so
okay.
So I mean,
okay, Chiamaka, go ahead.
Should I go?
If Chiamaka can go first.
Let me allow Chiamaka.
Okay, thank you.
Yeah, go ahead,
So, so I mean, it's difficult to invest when the economy is not going on very well, that inflation is high, there is tension and everything. However, the keynote actually addressed everything because we still have to invest, we still have to save for the future. So diversification is one of them into different asset classes, stocks within the capital market and outside the capital market. Real estate is one. Business ventures are other forms of investment that we can leverage to do that. So just to say that even within the difficult financial landscape, we still need to invest. And so we should find other alternatives to investment. Thank you.
Thank you for that. Mr. Oturu, do you want to add?
Okay, thank you, Chairman. Interestingly, very interesting questions. Now, for those who are not Christians, I need to apologize first. The Bible says that as long as the earth remains, seed time and harvest shall not cease. Meaning that if you don't invest, somebody else is investing and they are reaping the harvest. So it's important that, and for every difficulty, you find that difficulties also bring opportunities. So in this difficulty, what are the opportunities? There are companies who are, reinventing themselves, and based on how the world is evolving. I mean, Tesla is an example. People are moving to renewable energy. Tesla produces electric cars, and then there are incentives when you buy electric cars. So Tesla owner is now the richest person on planet Earth. So as the world evolves, opportunities will evolve, because difficult times, people who provide solutions during difficult times, they are the ones that reap the benefits. So people will always invest. We also just need to keep ourselves abreast of information, be engaged, talk to the professionals. There are always opportunities out there, I can assure you. Thank you.
So for me, what I would like to advise as a regulator is that if someone wants to invest, the key, like I said before, is there has to be an objective. What's the goal? So if you have some money that you have by way of inheritance or by way of savings, and you want to invest, once you establish that goal, then you want to look at your risk appetite. What level of risk can you take? If you are not a risk taker, you can't invest in certain asset class. You probably want to preserve your capital. So, but then in the process of diversifying your portfolio, you now have to also look at your own needs. How often do you need cash to meet your maturing obligations? So once you're able to tie that, you can now structure your portfolio in a manner that you would have so diversified it that it would have also taken care of the level of risk. Like Shea have said, there are a whole lot of asset classes that you can invest in. Let me borrow his word, there is seed time and harvest time. So which means that at every point in time, there are assets that continue to pay. But are you willing to take the risk? If you're willing to take the risk, then you jump at it. Structure your portfolio in a way that if that risk crystallizes, it doesn't burn you completely. So that is what I would advise. And of course, continue to make sure that you review that your portfolio in line with your current realities. So that whenever you review your current reality and you find out that, no, you cannot continue to hold this asset class, then you want to look for a way to exit when the time is right. So some people are so greedy that they want to invest in high-paying investment, high yield paying investment. And of course, you know that the higher the return, the higher the risk. So once you are willing to take the risk, then you can go for it. But know that if it burns you, then you don't need to cry to the regulator to say, or to come as, you know. So it's important that we yield to this advice. It's the ABC of investment. You must know your objective, know your risk, then diversify your asset portfolio in a way and manner that it meets your current status. Thank you.
Indeed, investment is a risky business, but diversification is a way to manage that. Okay, we have a question again from YouTube. Please, can someone shed some light on restructuring? We buy shares from a company and sooner or later there is restructuring. What are the causes of this and how can we be protected from this? So I was wondering if anyone wants to speak to this. I'll just open it up.
Maybe I can take a shot at it. So
yes,
companies, and thank you, companies restructure basically. They restructure either their operations, but I suspect this restructuring is talking about capital.
Yes, sometimes that can.
You know, so for example, a company has issued too many shares. One, its dividend per share is inconsequential because it has so many shares in issue. The price is nothing to write home about because there are too many of its shares out there. And the company takes a decision to rationalize the number of shares. Now, interestingly, when that is done, technically, the investor does not lose value because if you had 10 shares, for example, trading at ₦1 each, then you could have one share trading at 10 naira because the number of shares have reduced. So also is the value. But like we always say, you can't really insulate yourself against this happening, you know, because the investment can go either way. And we always come back to the need for you to stay abreast of information, stay abreast of the market, be close to your advisors, and spread your risk. Ultimately, if your risk is well spread, you will be insulated, or at least to some level, against a particular sector or a particular company not doing so well. Investment is a risky business, and like Mr. Breeze said earlier, the return for taking risk is profit. If you don't take risk, there's no profit, which is why if you put your money in a savings account, they pay you a 5% guaranteed return. Meanwhile, if you put it in bonds, the value can go up or down. You may earn as much as 27% return. So it's a question of looking at your risk and determining which sort of risk you want to take. And of course, Mr. Breeze explained earlier that you want to look at your cash needs. So your portfolio is structured in a way not only to protect you, but also to guarantee that if things don't go well in a particular area, it's not totally destructive. Thank you. And again, you know, I bring the Bible here. I like to reference the Bible a bit. I'm not a pastor, but the Bible even tells you to spread your risk. It says, spread your bread on many waters because you don't know which one will be successful. That's from the Bible. So risk management, was first described in the Bible where someone said, look, I will spread my family. I'm traveling. You put one family, one set somewhere, put another set somewhere. That's risk management. And as we journey on this investment, building sustainable wealth, we must realize that risk management is very key to this process. And spreading your investment is part of that risk management. Thank you.
Thank you very much for that. Another question, is it possible to have stocks insured the same way NDIC provides some cover for bank deposits, even if the percentage of the investment has to be paid as a premium? Wow, this is risk management 2.0.
I think there is investor protection.
Well, I mean, my understanding of investor protection, I don't think it addresses this point.
Well, I don't know. I'm not finished. So I know there's investor protection, but I don't want to say that there is some kind of NDIC kind of protection in the market. So, of course, investor protection is when something goes bad, right? But for equity, where you invest, it's already a risky business. So you either lose or you gain. By the way, you gain is that you gain by either capital appreciation or continuous payment of dividend over the period. You can get your capital appreciation if you sell on the floor of any of the exchanges. But of course, for some purposes of my practice, when the companies wind up, the assets are shared, from, of course, companies structure, the capital structure includes debt and equity. So if a company is liquidating, you want to settle those debt elements, creditors and all that. So the shareholders who are the equity holders are the bottom of it, which you can always reflect around the shareholders fund to see what's happening in the company. So there's no NDIC, but of course, at certain points, there is investor protection fund, which can protect investors to some extent, not investors who intentionally go and bust the bubble by investing in overpriced securities, but for some kind of malpractice in the market that involves some kind of losses that investor protection fund can cover to a certain extent. Yes, but equities are completely the last of the bottom. So at some point, if the company goes bad, and after paying all the creditors, there's no return for the shareholders. So in fact, the shareholders will need to meet some obligations. Thank you.
Yes, thank you for that. I think there's a reason I heard many years ago that markets are intoxicating when they're going up, or very devastating when they're going down. The devastation is because it's the nature of the asset. So the asset is not a fixed income asset that you can be sure of your return. It's one where you can actually, in a worst case scenario, lose your investment. But you wanted to speak to this, sir, Mr. Oturu. Very briefly, please.
Thank you, Ole. So, thank you, Mr. Briggs. So the equity shareholder is the ultimate risk bearer, and we need to understand that. The equity shareholder participates in the risk 100%, also participates in the upside up 100%. So when you understand that, then you can situate where you are. You are the risk bearer. So there's no insurance per se, but markets have devised different ways of hedging. There are products, especially in more developed markets, that can help you to hedge against the risk of investing in.
But I think ultimately, diversification is part of that process.
But
that's why you really invest in one.
Yeah, ultimately, the equity investor bears the risk 100% and bears and enjoys the upside 100%. Thank you.
Thank you, sir. All right. I mean, we continue to have questions, but we really need to begin to round things up now. So I want to say a big thank you for our panelists for spending so much time with us today and sharing their perspective. I believe it has been very valuable to everyone up to this point. I would appeal to them that if possible, while we wind things down, you can just type in responses in the Q&A field to any questions we haven't been able to tackle yet. And on that note, I would like to now yield to invite to deliver some closing remarks, the Head of Client Services and Business Development at Coronation, Registrars, Mary Adeleye. Mary, it's over to you.
Panelists, and moderator, good afternoon, ladies and gentlemen. My name is Mary Adeleye, Head of Client Services and Business Development at Coronation Registrars Limited. As we bring this enlightening webinar to a close, I would like to express our sincere gratitude to every one of you for joining us today for this insightful discussion. Your active participation and insightful contribution made this session a valuable learning experience for all our participants. We appreciate your commitment to building a more secured financial future, and we trust that the valuable information shared today will guide you in making informed decisions about your financial well-being. I would like to express my gratitude to our keynote speaker, Mr. Oluseyi Owoturu, President and Chairman of Council Institute of Capital Market Registrars, for delivering an informative presentation on the event theme, the role of capital formation and dividends in building sustainable wealth. His wealth of experience provided valuable insight into the pivotal roles of dividend and strategies for leveraging capital formation in building sustainable wealth. A heartfelt thanks also go to our esteemed panelists, Mr. John Briggs, Regulatory Compliance Specialist at the Securities and Exchange Commission, SEC, Nigeria, and Mrs. Chiamaka Ugo Obidike, Chief Client Officer, Coronation Registrars Limited. Your valuable perspective have enriched our discussion and deepened our understanding of the tangible benefits that dividend offer in providing financial sustainability. Thank you. Furthermore, I would like to express my appreciation to Mr. Wale Famiru, our moderator, whose skillful facilitation ensured that our discussion remained engaging, informative, and productive. Lastly, but not least importantly, I would like to extend my gratitude to Mr. Olurotimi Aleshiloye, the Managing Director, CEO of Coronation Registrars Limited, for his opening address that sets the context for the event. Together, let us continue to champion the cause of financial sustenance through informed decision-making and strategic utilization of registrars' solutions. Once again, thank you all for your participation, and we look forward to continuing this journey of learning and collaboration in the future. Have a wonderful day ahead and enjoy the rest of your day. Thank you.
Thank you very much, Mary. Thank you again to our panelists, and thank you all for joining us. Also, those joining us on YouTube, we appreciate your company today, and we believe that it's been valuable to you. So we look forward to your business at Coronation Registrars, and enjoy the rest of your day. Cheers.